the long-term case for gold and silver is crystal clear, as far as I'm concerned. You have central banks, foreign governments will continue to buy gold and silver now. Between October 17th and October 20th, which I think would have been Wednesday to Friday, 6,000 contracts were written for immediate physical delivery in gold. And each of those were daily records. Once countries accept payment in yuan, like Russia sells oil or Brazil sells soybeans, they don't have to just sit on stacks of Chinese yuan. Through the Shanghai Gold Exchange, those yuan balances are actually convertible into gold. And this means that exporters who don't want to hold yuan can take that money and they've earned and go right to the Shanghai Exchange and convert it into gold bars. It's effectively a yuan to gold backdoor. And the next vault, as we talked about, is being built in Saudi Arabia.
In today's discussion, we dive into powerful insights shared by veteran precious metals analyst Andy Schectman. With decades of experience in global finance, he highlights the growing cracks in the US dollar dominance and how they're fueling a worldwide rush into tangible assets like gold and silver. Recent price movements have confirmed this trend. Gold has been testing record highs, showing strong demand even after brief pullbacks. Schectman explains that this strength isn't just market speculation, it's a structural shift as nations and investors hedge against currency debasement. Silver, meanwhile, continues to trail gold slightly, but its industrial demand and limited supply position it for explosive potential once global momentum shifts fully. A key factor behind this transformation is the changing relationship between China and the United States. As China strengthens trade alliances and accumulates massive gold reserves, the global financial order appears to be moving away from dollar dependency. Schectman believes this transition marks the early stages of a new monetary era, one grounded in real value, not printed promises. Before we continue, don't forget to like, subscribe, and hit the bell icon for more updates on gold, silver, and global market trends.
And I won't know until tomorrow or later tonight what has precipitated this last pullback. We'll talk about last week's pullback in a moment and some of the things that I found interesting about it. But I mean, look, first and foremost, the long-term case for gold and silver is crystal clear, as far as I'm concerned. You have central banks, foreign governments will continue to buy gold and silver now, unless there is a fundamental change in the attitude of this country, in particular Congress, towards the U.S. budget deficit and the nonstop continued deterioration in our fiscal condition and our fiscal sanity. Our fiscal irresponsibility is off the charts. And you can see that by the continued shutdown of the government. And I think there'll be volatility. Look, this is a game where, largely because a lot of things that we've been talking about since 2020, when I started talking to you about the deliveries that we saw, those were the beginning signs of a system that is all about paper promises, rehypothecated paper promises coming unraveled, where countries and sovereign wealth funds and very plugged in individuals and groups realize that it is indeed the Achilles heel of the entire system, and they would rather, I think, slowly exploit the metal and the commodities out of the system before there is a mad dash for them. And you know, a lot of people in this country, instant gratification isn't fast enough, and we've seen that with the rise and proliferation of cryptocurrencies and stocks like Nvidia and Apple that have defied gravity. But I think that when you see the stuff that's going on, where in October already, almost 39 million ounces of silver have been delivered to the Comex. The phrase is issued and then stopped, which means taking delivery. Whether or not they leave the Comex is irrelevant. It's relevant because this is almost triple what was posted for delivery in October on the first day notice. In other words, most of the people who stand for delivery on Comex will do so on the first day notice. But what we have been seeing is deliveries like in gold that are 93% higher for the month than posted on the first day. This is contracts that are bought during the delivery month that instantly deliver, and they're much more difficult to analyze when you're trying to look at the Commitment of Traders report. But it's also very bullish in my mind. And as an example, between October 17th and October 20th, which I think would have been Wednesday to Friday, 6,000 contracts were written for immediate physical delivery in gold. And each of those were daily records for this point in the delivery period. And so, in essence, what we saw in my mind last week was driving down the paper price and immediately delivering contracts for the current month. They would drive down the December paper price, the futures, and stand for delivery an immediate contract in October. So what was interesting to me about it as well was some of the, I think it's Michael Lynch, I think is his name, I'm pretty sure. Sorry, Michael, if I got that wrong, but I think that's who it is. And he writes a report dealing with Comex, and he talked about the footprints that he saw, that the two entities that, first of all, on, I want to say Thursday and Wednesday or Thursday night, the price was driven down after New York had closed. And it was driven down in between New York and China, Asia, where there's virtually no liquidity, where no rational trader would ever dump metal, copious amounts all at once into a very thinly traded illiquid market. Period. No one would ever do that. They did. And it's done for effect, specifically for effect, to drive down the price, to guarantee the absolute worst settlement, the way that it should have been done. And when the mainstream talks about this, they neglect to tell you, well, by the way, it was all dumped in the middle of the night or, after New York trading. That would change the outcome. I think it invalidates the valid reasons. It was done for effect, not the way that it should have been done over hours or days, bled through New York where there's great liquidity to ensure the best settlement. Anyways, what I found interesting was he talked about the two big buyers that came in and drove silver price up into the green after being down $1 and gold about halfway up. Because remember, when they drive the price down, the algorithms that control the hedge funds, they're not emotional. And if levels are breached, they just sell. So selling begets selling begets selling. But I found it interesting that he notes that both Morgan Stanley and Bank of America came in and were big buyers of physical as the paper price on the December contract was driven down, which drives the spot price way down. They issued October immediate delivery contracts, which were setting records for massive amounts. The U.S. government added $1 trillion to the debt in 71 days last month. 71 days, from 37 to 38 trillion just recently. And the interest cost on the debt is mounting at a level where, it's now the largest budget item. And none of this includes the unfunded future liabilities, which are so large and disgusting that I don't know how you pay them off without devaluing the currency. Ultimately, that is how it has to be done as far as I am concerned. Again, think about this. We added $1 trillion in 71 days. That's just unheard of, and it's unsustainable. And our debt is rapidly approaching 130% debt to GDP, where other than Japan, no one's ever come back from that. And, the difference with Japan is that, they're not the world reserve currency. They have a budget surplus, and their debt not only is contained with yield curve control, it's mostly owned by the hedge funds, the government, and the people. And so they can get away with it. We can't. And if you're holding treasuries and you see the fiscal irresponsibility mounting, at some point, this debt does become a problem. And the people who point to it not being a problem, I think, are missing the picture. And that's why you're seeing, as an example, China building its own financial plumbing to get around the U.S. dollar system because it's no longer trusted. And, we focused a lot on Enbridge, but the CIPS system, the cross-border interbank payment system, which is China's version of SWIFT, is, in my opinion, the rails to what the Enbridge system will be. It's over 185 countries already are using CIPS to settle, including the Asian countries, which we've talked about before, which are 35% of global GDP right now, and China's biggest trading partner, twice the population of the United States. But the kicker is that once countries accept payment in yuan, like Russia sells oil or Brazil sells soybeans, they don't have to just sit on stacks of Chinese yuan. Through the Shanghai Gold Exchange, those yuan balances are actually convertible into gold. And this means that exporters who don't want to hold yuan can take that money and they've earned and go right to the Shanghai Exchange and convert it into gold bars. It's effectively a yuan to gold backdoor. And the next vault, as we talked about, is being built in Saudi Arabia.
In a world where the financial landscape is shifting faster than ever, seasoned market analyst Andy Schectman sheds light on the quiet transformation taking place behind the scenes. He explains that the US dollar, once the unquestioned pillar of global finance, is steadily losing credibility as nations seek refuge in tangible value. Central banks, particularly in the East, are accumulating gold at record levels, signaling a move toward a new monetary balance rooted in trust and substance. Gold's recent surge reflects this sentiment, not a speculative rally, but a reawakening of real money in a time of monetary uncertainty. Silver, often the overlooked counterpart, stands ready to follow with unmatched potential as industrial demand grows and supply tightens. Meanwhile, the evolving relationship between China and the United States underscores this power shift, trade tensions, de-dollarization efforts, and gold-backed strategies are rewriting financial alliances worldwide. As this global reset unfolds, one truth remains clear. Tangible assets are reclaiming their place at the center of stability. If you found this insight valuable, don't forget to like, subscribe, and tap the bell icon for more updates on gold, silver, and the evolving world economy.